All right, well, we're going to go ahead and get started here, Michelle. Welcome. And welcome to all the participants who have joined us today for a very, very interesting topic. Everybody wants to know all about joint ventures, teaming agreements, mentor protege. And Michelle, you come with a wealth of knowledge. So I welcome our speaker, Michelle Cantor. She's the chair of federal government contracting and procurement with McDonald Hopkins. I am your host, Reena Bhatia. I am a board member of the Asian American Chamber of Commerce. I'm also the CEO of Proposal Helper and Bid Execs. I just want to give a few opening words about our chamber. If you are not a member, we would like for you to join the Asian American Chamber of Commerce. Is dedicated to improving the economic development of all businesses. We are focused primarily in the Virginia, DC, and Maryland area, but we have members from all over the country. So again, part of what we do is bring on amazing speakers like Michelle to educate the government community. I am part of the government committee, and we really would like to have you as members. There are a lot of things that we do for members only. So you're probably missing out on some of the more deeper conversations that we have. Join us if you're not a member already. A quick disclaimer about today's webinar. This webinar is being recorded. It will be available about a week after we're done here today. It will be available for you all to review and distribute and share with everyone. But please remember that this webinar is for informational purposes only. It does not constitute any legal opinion or legal advice. With that, I am going to have our speaker introduce herself because I would do no justice to your background, Michelle. So I'm going to turn it over to you to introduce yourself and start sharing your slides and give our audience all the fun information that you can about our interesting topic today.
Thank you so much. And I want to thank the Asian American Chamber of Commerce. I'm really thrilled to give this presentation. Thank you so much. So I'm a partner at McDonald Hopkins, which is a full service law firm with 5 offices nationwide. I'm also the chair of the federal and local government contracting group, where we do certifications, whether they're 8A, SDVOSB, HUD zone, WBE, MBE, DBE, as well as appeals, certifications and appeals, bid protests, size protests, NAICS protests and appeals, a lot of preparation of joint ventures, teaming, and mentor protege submissions, succession planning, mergers and acquisitions, where small companies either want to purchase small companies or small companies looking for an equity infusion of capital into their firm, do contract claims, requests for equitable adjustment, and government regulation compliance. A little bit about me. I don't know why that wacky pictures there, but I've been practicing law for over 33 years in the government contracting field. So if you have any questions, please not email them, but use the chat. And then after the presentation, you can email questions to me directly at this address. And then it's also, this address will be at the end. So teaming, joint ventures, and mentor protege, the good, the bad, and the ugly. So what's the good stuff about teaming, joint ventures, and mentor proteges? Well, it certainly adds capacity. It adds capability. It could give you boots on the ground in a geographical area that you're not familiar with necessarily. It can enhance your past performance and help you to win contracts. And it could reduce liability by sharing work responsibilities. And I can go on and on and on about why teaming and joint venturing is good. And we will talk about the good things today, but the bad and the ugly is really what I want to talk to you about, especially in light of people going after, for instance, the STARS 3 contract and teams and joint ventures, and the government is really starting to increase their solicitation thresholds to very, very high amounts on restricted competition. So, so restricted competition could mean you and your teaming partner or joint venture partner could be going after a $50 million contract or a $100 million contract with which is a long-term IDIQ. So everybody's looking to scramble a team and put together joint ventures. And I just want to talk to you about and Mentor Protege programs. I just want to talk to you about being careful about these things and what to do and lessons learned. So the bad is, the bad part about teaming with someone is maybe you were really able to do all the work yourself and you're giving up work share. The bad is trusting in the wrong teaming partner. The bad could be less control over performance, even if, in terms of your subcontractor. Liability if the teaming partner defaults. So for instance, if you have a subcontractor and they default on the contract, the government doesn't care. You're going to be held responsible as the prime contractor. Affiliation due to ostensible subcontracting. Mentor terminates the mentor protege agreement when the mentor protege with the MP team is not awarded the contract. And I've seen this. I've asked proteges. I said, oh, I thought you were in a mentor protege agreement. No, we put one together. The SBA approved it, but because we didn't get the large contract, the mentor just dumped me. So those are some lessons learned and things like that that we want to be aware of. The very ugly are getting into bid protests because of the teaming arrangement. I've seen work share disputes in both teaming and joint ventures, profit disputes, delay disputes and non-performance disputes, exclusivity where one of the team members believes the other one cannot go ahead and team with someone else, and other types of set-asides, non-disclosure breaches. I've seen where teaming partners have stolen each other's clients, and I've seen fraudulent misrepresentations. Getting into the wrong teaming agreement could mean a negative CPAR rating. I've seen where teaming partners filed bankruptcy, and then the prime contractor had to went into default and got terminated for default. Stealing of trade secrets and proprietary information from teaming partners, and refusal to cooperate in pursuits of change orders or REAs. So the bottom line is know your teaming partner, put the details in your written agreements. When all is said and done, I believe that teaming, joint ventures, and mentor proteges is your best chance of winning contract awards and successfully completing the work, but you have to do it right. So let's talk about federal business teaming and all the crazy, crazy rules out there. So as you know, that the federal government's policy is to give the maximum practicable amount of business work to women, SDVOSBs, economically disadvantaged 8A firms, and small business firms to participate in the performance of contracts. And the government does that, and this is their goals, and many of you know their goals. I'm going to skip past, I'm going to go really fast on some of these slides. I know this is set for an hour. Some of you have more than an hour, some of you have less, and so I just want to try to hit the big stuff, but I will be going on for the whole hour. How does the government accomplish those goals as prime contract and giving you the most amount of participation? Well, the government will directly contract to you as a small business, whether it's a sole source or restricted competition, or they make large businesses have subcontracting plan mandates. This is the subcontracting plan law, that any contract that is expected to exceed 700,000 or 1.5 million and that has any subcontracting possibilities has to have a subcontracting plan. So even though you don't want to bid something as a prime contractor, you could always look to a larger prime contractor and be a part of their subcontracting plan. So these are in small business federal set-aside world. Examples are if the government can sole source directly to you as an 8A, a hub zone, an SDVOSB, a small business, or a woman-owned small business. Please note that if you're an 8A business, there's special rules where a contracting officer does not have to justify the sole source award versus unless it exceeds a certain dollar threshold, but it does have, a contracting officer has to justify a sole source award to hub zone, SDVOSB, women and small business. Set-asides are for all small businesses, as you see, and then there's bid evaluation preferences in being in these programs, like the Veterans First program, where veterans take first in any VA work, and then a hub zone price evaluation preference. A lot of people ask me, what are the relationships among small business programs? Is there parity? And the answer is there's parity. That means that they're all treated the same in terms of priority. But SDVSB, HubZone, WOSB, and 8A has actually a higher priority than small business. Well, then I always get the question, then why are the contracting officers, especially around August and September, doing so many sole source and so to 8As? Well, because it's just a lot easier to do that because of not having to take the time to put out the solicitations. However, each agency has to report their goals every year. This is just a HubZone protest where a HubZone was one of them was mad that they didn't set it. The woman-owned firm was mad that they gave a HubZone sole source contract, and so the GAO said it's perfectly okay because the agency had not met its HubZone goals that year, and they were just trying to meet that goals. So how does the government set aside? It's always about the rule of two, meaning set aside for just women businesses all over the country can bid, or just veteran businesses, or just 8A businesses. That's considered a restricted competition, or competition restricted to small business or women-owned businesses. And the FAR 19502 says the procurement shall be set aside for small businesses unless the contracting officer determines that there's not a reasonable expectation of obtaining offers from two or more small businesses. They call that the rule of two. So let's get into even how the contracting officers determines this, okay? And it's through market research. So FAR 19501 states the contracting officer shall review acquisitions to determine if they could be set aside for small businesses. And you see the word shall, that's mandatory. Next paragraph, the contracting officer shall perform market research. And how do they perform market research? Well, they do it at conferences. They do it when they have booths at, for instance, Society of Military Engineers conferences. They do it by looking you up in the dynamic small business search from the SBA. They do it by looking up your websites. They do it by you're visiting them, doing capability presentations, whether it's a Zoom nowadays or in the past, in-person capability presentations. So it's really, really important that you aggressively market your small business status, especially if you're new to the market. So going after the small business procurement. So you look at a new solicitation or a source of sought and say, do I qualify under the snake's code? Do I have the experience? Am I a small business? Does my firm have the capabilities? Does my firm have the capacity? Do I need to subcontract work? Do I have the required past performance? Do I meet the criteria to submit a responsive offer? Do I need bonding and I don't have it? If any of these are no, I would strongly consider teaming. Who can team? So if you're in the commercial supplier diversity market, meaning your customers are private customers, so maybe BP Amoco, could be Hilton hotels, Hyatt hotels, casinos, anyone can team as long as the customer allows it. For the federal market, an open competition, meaning there is no restriction to women or any small businesses, no restrictive set aside, anyone can team. So you could team with a large business till the cows come home when it's an open competition. But if it's set aside for small businesses, there are very strict rules, which we're going to go into. Why is teaming desirable? Well, unlike other government regulations, let's say in the state of California or the city of Los Angeles or the city of Minneapolis, the federal government has a FAR that basically say the teaming is encouraged by the federal government. So they state that contractor team arrangements may be desirable from both a government and industry standpoint to complement each other's unique capabilities and offer the government the best combination of performance and delivery. So questions that I get: my company XYZ wants to do a teaming agreement with an individual engineer. It's not a company, it's an individual engineer. Is that okay? My company is a small business, wants to do a teaming agreement with a large business. Is that okay? My company wants to do a teaming agreement with 3 other small businesses. Is that okay? Well, in all the circumstances, the answer is it really depends on what the solicitation states, what are the requirements, and who your teaming partners are. So the definition of a teaming agreement is where two or more companies form a partnership or a joint venture to act as a prime, or a potential prime, meaning you, a small business prime, agrees to work with one or more small companies to have them act as subcontractors. Why is teaming unique to the federal government? Well, in the private sector, and many of you work in the private sector or work in the government sector, meaning the city of New York or city of Washington, D.C., and you're bidding on a project to a prime contractor, there's no allegiance, right? So the prime contractor may ask, you might be an electrical contractor. The prime contractor may ask 3 of your competitors to also bid to them. So there's no allegiance or collaboration. And in the same way, subcontractors might bid to 5 different primes. But under the teaming arrangement, it's normally the allegiance, okay? Normally, there's an exchange for the prime contractors, in exchange for the prime contractors awarding you the subcontract, you won't work with other teams. So there are generally 2 types of teaming arrangements. This is from the SBA. A potential prime contractor agrees with 1 or more other companies to act as a sub, or a joint venture, where you as a joint venture group together with another company or companies and act as a prime. And here's an example of a prime subcontractor where the U.S. government is the customer, you as a small business are a subcontractor, and then you might subcontract to others, okay? That's prime subcontract team we're gonna be talking about in teaming today, as well as a joint venture. And under the U.S. government is the customer, the joint venture is your company and your JV partner, and then the JV subcontracts to both of you for under a small business set-aside joint venture, and the joint venture might actually subcontract to other people, other subcontractors as well. One of the things I don't want to forget that I'm going to mention now is that under this arrangement, you have to talk to your joint venture partner as to whether you're going to have the joint venture subcontract to all the other third parties, or are you individually as subcontractors going to further subcontract other work out. So the difference between JVs and teaming is a joint venture. You're both at the table because you're both owners of the entity, the joint venture that has the contract with the customer. There's a sharing of liabilities and a sharing of profits. Under the teaming agreement, only the prime has liability to the government. The subcontractors don't if there's a breach of contract, right? There's no shared bank accounts as there would be in a joint venture, a small business joint venture. And there's no sharing of profits. Each of you make your own profit as a prime contractor and then also as a subcontractor to the extent that you are a sub. Know your teaming partners. We're going to talk about affiliation, limitations of subcontracting, etc. So be very careful when you are working with self-certified businesses. So for instance, under the SDVOSB, under the VA, if you are, if you're going to be joint venturing with, for instance, another small business, your joint venture has to be certified. If the prime contractor is going to go after a VA contract and it's an SDVOSB, the prime contractor needs to be CVE certified. If they're self-certified, it could be a problem if, for instance, it's a self-cert under an Army Corps of Engineers contract, you're a subcontractor to a self-certified veteran firm, that it could be open to a protest because they haven't been verified by anybody. They've self-certified and they may not know the rules on self-certification. The same holds true up until now for women-owned small businesses. So if you're teaming with a woman-owned small business that's simply self-certified and didn't really know the rules of what is really the eligibility criteria for a woman-owned small business, you could potentially be bid protested and lose a contract if the woman-owned small business truly did not meet the eligibility criteria. However, as of July 15th, the SBA began to enforce its new rules, implementing the National Defense Authorization Act of 2015. So it eliminates self-certification option effective October 15th. Starting July 15th, though, you can go online to the SBA website and actually certify to the SBA at no cost. you'll have to upload certain documents, and starting July 15th, if you're certified by a third-party agency like the Women's Business Development Center, WeBank nationally, or NWBOC, or some other third-party certifiers, you have to go still yourself, go into the SBA website and then upload your certification documentation. Crucial about teaming and joint venture rules. Limitations of subcontracting applies to all set-aside contracts. What do we mean by limitations of subcontracting? Well, the SBA says, look, if we're going to set aside an SDVOSB contract or an AA contract, we want you doing that work, and we don't want other people doing that work. So you need to at least perform a certain percentage of that work. Up until recently, in the last 2 years, the SBA changed the limitations of subcontracting. However, the FARs had not changed. So many of the solicitations still contain the old language. So you need to be clear as to whether the solicitation contains the new language or the old language. The old language said that if you submit an offer for a small business set-aside, you promise that if it's a service contractor, you must perform at least 50% of the cost of the work with your own employees. For general contractors, you must perform at least 15%, specialty trades, 25%, etc. But the new rule kind of changes it up a lot. And the way it changes it up, it says that, and this is the new rule, in order to be awarded a small business set-aside, an 8A contract, an SDVOSB, HUB-zone, woman-owned, etc., in the case of a contract for services, no more than 50% of the amount paid by the government to the prime, which would be you, may be paid to any other firms at any tier that are not similarly situated. Now, this rule was supposed to clear up the old rule. Most people think it does not. Most people think there's a lot of problems with that because it doesn't address employees anymore or anything like that. But it is what it is, and so let's talk about what that actually can look like. So in the case of construction, the new rule says that if in the case of a contract for general construction, no more than 85% of the amount paid by the government to the prime may be paid to firms at any tier that are not similarly situated. And then, of course, specialty trades is 75%. So I see problems there. I see problems in that it says no more than the entire contract price will be paid to the prime contract, for instance, 50%. Well, then how do you gauge that? You really can't gauge it to the very end of the project. And so people are promising that they're going to self-perform 50%, or they're going to not pay out their subs more than 50%, but now you're at the end of the project and it may happen, right? Or you're at the end of the project and some prime and you're a sub says to you, you know what, I really can't make that last payment to you, because if I do, I'll violate the limitations of subcontracting. Me, myself, I see the limitations of subcontracting. I think it should have been called instead the limitations on payments. And then we're going to get into what a similarly situated entity is. Many people ask, well, what about long-term IDIQ contracts when they are task order based, etc.? And the law says, or the SBA and FAR say, that the compliance is required for the base term of the contract and any option period. However, the contracting officer, in their sole discretion, may require the concern to comply with the limitations of subcontracting for each task order awarded. So watch that. Look at the solicitation very carefully to see if you have to meet the LOS, limitations of subcontracting, for each task order. So more on this limitations of subcontracting, I want to focus on number 3, work performed by an independent contractor. Many of small businesses hire an individual person versus a company, and they call them 1099 contractors. But they in their minds they count them as employees. They are not employees, as you see under the SBA's regulations 13 CFR 125.6. Work performed by an independent contractor shall be considered a subcontract and may count toward meeting the applicable limitations of subcontracting where the independent contractor qualifies as a similarly situated entity. So let's look at what a similarly situated entity is. Basically, it's they share the same NAICS code, they're small, and they're the same type of business you are for the solicitation. So for instance, if the solicitation is a hub zone and they're another hub zone subcontractor, they would be a similarly situated entity. Service disabled veteran firm subcontracts to another SDVOSB, that's a similarly situated entity. So only first-tier subcontractors can be utilized to meet the limitations of subcontracting. Second-tier subcontractors are considered non-similarly situated. SBA positions on this is that there's if it's a similarly situated entity, there's no violation of the ostensible subcontractor. All right, I want to move on. Now, questions. Can an 8A, because of this similarly situated entity, or if I'm a veteran firm and I find a really good contract, but I find that I really don't want to perform it, but I know that I've got good past performance and I've got a good relationship with the contracting officer and they got good CFARs, can I simply, go after that contract and then later subcontract 100% of the work to a similarly situated entity? Well, the SBA rule is silent on that. It's totally silent. So potentially you can find a contract and subcontract it all to your or you could be awarded a contract, subcontract it all to another similarly situated woman-owned small business or SDVOSB. However, there is a FAR. This is not an SBA regulation, but a FAR on excessive pass-through charges. And the SBA has not talked about that difference, okay? If you want to know more about it, this is the FAR 52.2.15.23. Look it up. You could look it up or contact me on this. So teaming agreements. You've identified your teaming partner. You've found the right solicitation. You've researched and confirmed your teaming partner is a small business. You've agreed on what information is needed for the proposal. You've got a signed teaming agreement in place. Well, maybe not yet. Maybe you're just now drafting one. So they don't have to be in writing. However, I strongly suggest it. And the SBA even says that if teaming agreements must be carefully evaluated to determine the relationship of the parties, as it may give effect of a participant's eligibility determining actual control or affiliation. So if, for instance, your bid protested or size protested, the SBA will look at that teaming agreement. And then I found more and more contracting officers are asking my clients to submit teaming agreements along with their bid proposal or along with their responses to sources sought. So here's a teaming agreement, lessons learned 2014. It was an IDIQ design build for $95 million. The Navy correctly, this is what was held by the GAO, the Navy correctly refused to take into consideration the designer's past performance because the prime contractor's proposal did not include the teaming agreement, which was required. So check the solicitation to see if you need the written teaming agreement. What should be contained in my teaming agreement? Well, you want to identify who the team members are with their proper legal names. You want to be project specific and identify the solicitation or the sources sought. You want to identify each role the team member is going to play, who's going to do the contract negotiation, who's going to manage the contract, who's going to talk to the government. Is there a clear subcontract promise? And we're going to get into that in a second. Source of labor, who's going to be performing what labor? What is the term of the teaming agreement? Is there a confidentiality clause to discuss? To insert in there? Address the limitations of subcontracting. Who performs the vital and primary roles of the subcontract? Are you going to be exclusive in this teaming arrangement? Who's going to be responsible for false statements if you're teaming a partner basically gives a resume that's not true? Are you allowed to assign the teaming agreement to another company? If there's a dispute, will the dispute be heard in Hawaii or in Arizona? And are there any side agreements in there that merge into this agreement? And so no other agreements or prior agreements will apply. Other terms, I wanted to bring this up, is that I've seen this in solicitation. If the prime contract specifies a U.S. government or military security classification, Such specification will be applicable to any resulting subcontract. For contracts requiring access to meet classified information, the subcontractor shall meet the security requirements of the customer. So make sure you read those solicitations very, very carefully. Remedies for breach of contract. Well, most teaming agreements that people borrow from each other or off the internet don't talk about that. You might want to consider limiting your liability on a teaming agreement. You don't want to be responsible for loss of profit or revenue of the other parties. Here's language of what not to do. Teaming agreement shall apply to all federal contracting solicitations. Team members are prohibited from teaming with any other firms. That could also be a recipe to lose your 8A or any other status you have, SDVOSB, because you now have a contract or an agreement with someone that gives negative control on your company. Service contract, remember you have to perform at least 50% of the work. The large business team member shall be responsible for 80% of the work. That's a no-no. Prime subcontractor teaming subcontractor, where in the teaming agreement it says the prime is gets a shares profit 49.51. So that's, you know, you're sharing profit. Think about joint venture, not prime subcontractors. So many teaming agreements provide for arbitration. Maybe you want to think about one arbitrator versus 3, because arbitrators can be very costly. And then I've seen where there's actually no teaming agreement, but they have a non-disclosure agreement, and the non-disclosure agreement has all kinds of teaming language in it and prohibitions from teaming with other people. This is an interesting case on CyberLock, and there's like 3 or 4 of them, and I'm just going to talk about CyberLock. And well, I want to talk about Navarre too, but CyberLock, the parties agreed that if the general contractor secured a prime contract, it would enter into a subcontract with the subcontractor, where the sub would perform 49% of the work. And there was a lawsuit that ensued after that, and the court said this teaming agreement is unenforceable. And here's the reason why. They reviewed the teaming agreement, and they said the award of the work would require the negotiation of a future subcontract. The award of such work was dependent on the success of future negotiations. The work percentage may well change in the future, and it just was not specific enough, okay? Another case, Navarre, parties decided to go after defense threat reduction conference. Navarre was to act as the prime. There was an NDA created and a teaming agreement. The teaming agreement provided that if Navarre was awarded the contract, they would negotiate in good faith and reach an agreement on a subcontract. Navarre actually was awarded the prime contract for $55 million, but the parties couldn't agree upon the subcontract, and so Navarre went its separate way. But the parties sued Navarre because they said, you were supposed to use us as the subcontractors for that bid. And this went all the way up to the Supreme Court of Virginia, and the Supreme Court said that that teaming agreement was not enforceable. It was just agreement to agree in the future. The type of arrangement equates to a letter of intent. The contract's not enforceable where there's no mutual commitment, no sum specified, no formula for determining how to pay. Okay, so be very careful about that, and talk to your trusted advisor, your lawyer, or whatever that understands how to put together a teaming agreement and what needs to be put in a teaming agreement. Here's a nightmare, lessons learned. Company ABC and XYZ, 2 different companies, have a written teaming agreement for solicitation for an 8A set-aside. Company ABC is currently, let's just say, an 8A. Company XYZ was not an 8A. But both companies, though, are in the same line of business, both competitors with each other, in fact. The government cancels the solicitation, and a year later reissues it again as an 8A set-aside. However, ABC is no longer an 8A. So both companies find new 8As to propose as prime contractors, and both companies A and B, ABC and XYZ, will be subcontractors. So what's wrong with that? Well, you guys were probably sharing costs. You were probably sharing your proprietary information as it relates to how you're going to price the contract, what you're going to do, what are your strong points, what are your weak points. Or maybe you had a teaming agreement with an exclusivity clause that prohibit you two from ever going after this particular set aside, even if it's in the future. So here's some questions to ask your teaming partners, and I'm going to go over that, very fast. What are your primary NAICS codes? What are the locations? Are you union? How many employees do you have? Do you have any pending litigations? What's your federal project experience? And all this will be on the slides that you'll get. All small business joint ventures. So why I was asked by a contracting company out of, it doesn't matter where, but out of Arizona the other day, why would I bother being a joint venture? Why would I do a joint venture with a small business? Well, maybe you don't have the capacity, and the other company does have the capacity. They have the staffing. Maybe you don't have the capability, but your potential joint venture does have that expertise. Maybe the joint venture, your prospective joint venture partner has the past performance. Maybe you're located in Ohio, but the project's in Atlanta, Georgia, and you need boots on the ground. Sharing liabilities is also really nice, so you're not stuck holding the bag as just a prime contractor alone. Maybe you don't have the license needed, and so therefore you want a joint venture. Maybe you need bonding and you don't have enough bonding or startup costs. So my company XYZ wants to do a JV with a large company. Any issues with that? Well, yeah, because only two small businesses can joint venture with each other unless the small business is in a mentor-protege relationship with a large business. If they are an approved SBA mentor-protege program, meaning the All Small Business Mentor-Protege program, then the large business joint venture the large business mentor can joint venture with the small business protege. Other than that exception, only two small businesses can joint venture with each other. What is a joint venture? Well, an association of individuals or concerns in any degree agrees to engage and carry out more than 3 business joint ventures over a 2-year period. So that's the 3 and 2 rule. And it can't be on a continuing basis. So the SBA definitely, when they define joint venture, it's under the affiliation rules, and they say that a joint venture of 2 or more small business concerns can submit an offer as a small business so long as each concern is small under the NAICS code corresponding to the contract. So affiliation based upon joint ventures, be very careful if you continue to go into multiple joint ventures or you violate the 3 and 2 rule. The 3 and 2 rule is you could be awarded 3 projects under 1 joint venture over a 2-year period, and then you'll have to create another joint venture. Now there's a new proposed rule out by the SBA that hasn't been enacted yet, and that is you could basically be awarded numerous projects over a 2-year period. It won't just be 3. Paying attention to the amendment for a joint venture. So here, what happened is that an 8A and a non-8A got into a joint venture, and they did it for a specific project, right? But then they then after that went after another project, and they got bid protested, and so CRZWS was the appearant or awardee, but the SBA rejected the joint venture amendment for the new project because the joint venture was unfair and inequitable to the 8A firm. The charter brought little or no relationship to the 8A other than its 8A status. The contract was for waste collection, and the non-8A joint venture partner was the incumbent, and while the 8A was not even that type of business. So just because you've got an approved 8A contract by the SBA, an approved joint venture contract or agreement by the SBA, doesn't mean that it's a pass for all projects. You still have to, because you could still be affiliated for other reasons. New protest case, a small business with both an 8A and SDVOSB. Here, the joint venture agreement contemplated that the joint venture would bid on 8A competitive contracts, but said nothing about SDVOSB set-asides. The joint venture agreement must specify the responsibilities for the contract at hand, and the holding was the joint venture was not compliant. So you got to be careful if you happen to be a veteran, a woman-owned business, and an 8A business. Can you use the same joint JV for all 3? And the answer is you'd be very careful or talk to an attorney that knows how to do this, because otherwise you can be protested. And as you see here, the SBA ruled that the JV was non-compliant. More joint venture requirements. The joint venture agreement must be in writing. The JV may be populated with only the joint venture can no longer be populated. Okay, it has to be an unpopulated joint venture. The joint venture must be separately identified as SAM and registered in SAM as a joint venture. I want to talk about this slide's out of order, but it's really important. The SBA has proposed a new rule because of this. Solicitation required security clearance proof prior to award. MTSA asserted that the requirement is unduly restrictive of competition because it effectively prevents any unpopulated joint venture from receiving an award. They argued that the agency should allow an unpopulated joint venture to rely on security clearances that its joint venture members held. And the GAO said, an agency has heightened discretion to define solicitation requirements when the subject of the agency's acquisition relates to national defense. And although the MTSA, although the requirement is particularly onerous for unpopulated joint ventures because they don't possess facilities or employees, our decision explains that a protector's inability to satisfy a solicitation term does not render the agency's need improper. So what happened is that the joint venture itself needed to have the security clearance, but they couldn't get the security clearance because they bid as a joint venture. They're bidding as a joint venture versus individually, even though each of them may have had individually security clearances. So lessons learned, look at that solicitation very carefully. And perhaps they should not have bid this contract as a joint venture because they couldn't get the security clearance. Instead, they should have potentially, maybe they did in the long run, bid it as a prime subcontract teaming arrangement. Common problems in joint venture agreements: using other companies' forms found on the internet, using templates without modifying them to address specific projects, and do not address the risk, rights, and liabilities of the parties. So what should be in a joint venture? Well, here's an example, very much the same for veteran joint ventures, 8A joint ventures, women-owned joint ventures, and HUBZone joint ventures. The JV must be in writing. And for women-owned, I'm giving you a women-owned example, but the same for all of them. The women-owned or the 8A must manage the joint venture, must manage the prime contract. The WOSB employee must be the project manager for the project. The percentage is not 51-49. It's profit commensurate with work performed. There should be a bank account with both of you being signatories to the account. Does not require SBA approval, except 8A joint ventures do right now. In the future, that could change. It could be a separate legal entity, meaning you form an LLC, for instance, with the Secretary of State. And so it's your company, another company, you form a joint venture and you incorporate, for instance, with the Secretary of State. Work share, you need to definitely put in who's going to do what and that you're going to meet the limitations of subcontracting. You want to identify the term of the joint venture, how the joint venture, and if the joint venture is terminated. Anti-poaching, potentially, maybe you don't want your joint venture partner stealing your employees. What if you want to sell your company? Is there an anti-assignment clause in the joint venture, or should you talk about anti-assignment? Exclusivity. Just because you're in a joint venture with one other party doesn't mean you have to joint venture with them forever. And I have seen these disputes over and over again, where people believe that just because they're in a joint venture, even mentors believe this, with their protege, that they have to joint venture with them for everything. Is there a non-compete clause? When exactly is profit going to be taken? What about losses? Joint venture management? What about super majority approvals? What happens if your joint venture defaults? Is there an indemnity provision? Where will disputes be held? And who's got jurisdiction over the disputes? Joint venture disputes, once again, determining profit, when to pay profit, when the subcontractor invoices, warranty issues, joint venture account and checking, management responsibilities. Please avoid disputes and address these issues in your joint venture agreement or your operating agreement or somewhere where it's very clear cut as to how you're going to handle these issues. I'm going fast because, here's an interesting one. This is a joint venture between a mentor and a protege. AMME was the protege, and CME formed a joint venture. There was a protester. They allowed that the VCME is not eligible because AMME, the protege member of the JV, lacks the experience under the NAICS code, lacks the necessary equipment, and lacks capacity. AMME has 2 employees, while the mentor has over 1,600 employees and 400 million in revenues. Well, instead, the SBA focused on not that what they were doing, like between each other, and one didn't have the capacity. Instead, they focused on the joint venture operating agreement. And in the operating agreement, it says the joint venture operating agreement supplements the joint venture agreement, but does not supersede or nullify any portion of the joint venture agreement. The joint venture agreement was marked draft for discussion purposes only, and thus does not persuasively establish that an agreement in principle had in fact been reached. Also, VCME's joint venture agreement stated that joint venture partners would prepare a contract-specific addendum for each procurement. No such jointly executed addendum existed. So be very careful. I'm going to watch the time here, see how fast or slow I need to go. Small business, just understand that small business size includes your own small business or your partner's small business, and you have to ask your other partner small business, do they have affiliates? Because affiliates are included in the size standard for small businesses. Understand the definition of affiliates. NAICS code examples, I think most of you have seen these, and I could you'll certainly see them in the slides. Up until recently, even though in December 2018, Congress enacted the Small Business Runway Act, which extended gross receipts for, which have helped a lot of small companies that were graduating or had graduated because of gross receipts, and implemented a 5-year average as opposed to a 3-year average for gross receipts. Affiliation, these are the different types of affiliation that can exist, even if you're 2 small businesses, based upon stock ownership, common management, identity of interest, ostensible subcontractor, joint venture affiliation, and the SBA says that we're going to look at the totality of circumstances. Here's an interesting case that came in 2017. This is a Department of Justice posting. Virginia Beach, Virginia, ADS Inc. and its subsidiaries have agreed to pay $16 million to settle false claims. The settlement further resolves allegations that ADS engaged in improper bid rigging related to certain of the fraudulently obtained contracts. In order to qualify as a small business, companies must meet the defined criteria. The allegations that together with several purported small businesses that it controlled, ADS fraudulently induced the government to award certain small business set-asides to them. The purported small business affiliated with ADS include Mythics, London Bridge Trading Company, as well as MGL, which falsely claimed to be eligible service-disabled veteran-owned small businesses. ADS and its affiliates allegedly concealed the company's affiliations with ADS and knowingly made misrepresentations concerning the size of the business and their eligibility. Ostensible subcontractor, that only is, so if you're doing a prime sub situation and your prime contractor is large business, that's okay. But if the prime contractor is performing the primary and vital requirements of the contract, then affiliation can be found due to the ostensible subcontractor rule. The SBA says they have these rules for the purpose of preventing other than small firms, meaning large businesses, from forming relationships with small firms to evade the size requirements. So if you have family members that you're doing business with, even though this is a 2016 rule, a lot of small businesses don't know this, that there's a presumption of affiliation if you're doing businesses with your relatives. If that and doing business means subcontracting, joint venturing, financial assistance, loans, sharing resources, equipment, locations, or sharing employees, unless there's a clear line of fracture before you bid a project, and all those ties are cut. New Mentor Protege rules, the good, the bad, and the ugly. We know how great they are. The SBA Mentor Protege programs develop business as a business development protege. Mentors are encouraged to provide assistance, and the assistance is enormous. It could be enormous, okay? There's technical assistance and subcontracting assistance and financial assistance, and the mentor benefits because the mentor can now joint venture on a small business set aside. And then there's equity ownership, which I want to talk about in a minute. So the great thing about the Mentor Protege affiliation exception is the SBA Mentor Protege program states that no determination of affiliation or control may be found between a mentor and a protege based solely on the mentor protege assistance. But it could be found for other reasons. So understand, make sure, a lot of people just take each other's mentor protege agreements, they copy it and they submit it to the SBA, and it really doesn't even apply. And then they get bid protested, and the SBA said, you're affiliated. Well, why? Because your mentor protege did not contemplate for this type of assistance. So the SBA can basically hammer people if they don't comply with the mentor protege rules. Here's some of the mentor protege, a bit ugly. Be careful, the mentor protege must be legitimate and done for the right purpose. The larger the project, the likelihood of scrutiny. If it doesn't feel right, seek legal guidance on it. If some mentor approaches you and it doesn't seem right, seek guidance. Here's a situation where the mentor ended up getting indicted because the mentor was actually doing all the work, and the 8A actually blew the whistle on the mentor. Don't have side agreements with the mentor. Be very, very careful that if you go into a joint venture agreement with your mentor, ask, make sure you're very clear on expectations. For instance, some mentors charge for mentoring, and the SBA rules are silent on that. Okay, who's actually going to get the profit? When is the profit going to be split? How is it going to be split? Does the mentor, I mentioned this before, does the mentor expect you to be exclusive and you can't bid any projects with anyone else? Here's problems with, I see red flag when the mentor charges protege for assistance. The mentor only provides assistance if it gets something out of it. The mentor wants side agreements contrary to the mentor protege. The mentor had several terminated mentor protege agreements in the past. Mentor wants to share profit as a subcontractor to the protege. Now, I have this slide up, and we don't have time to go into these, but there is an allowance for a mentor to buy up to a 40% equity stake in the protege. But if the mentor happened to be an 8A before, it's a different allowance. So I do like a 3-hour workshop on mentor proteges, joint ventures, and we don't have time for it today, but I'd be happy to do a second session for you. But this is the new All Small Business Mentor Protege regulation. It says, notwithstanding the requirements of this section, in order to raise capital for the protege, the firm may own an equity interest up to 40% of the protege. However, just know that that gets you out of affiliation if you are a protege and a mentor and you're just doing federal work. But if you happen to be you as a protege happen to be a DBE or an MBE, let's say with the city of Miami, well, maybe the Department of Transportation, if the Florida Department of Transportation doesn't recognize that 40%, and you could be deemed affiliated, or you can actually get kicked out of the DBE program for your participating in the SBA program. So understand certifications before you allow equity ownership in your firm. Here's a situation where a mentor and a protege they did everything right. The mentor planned on buying a 40% equity stake. They got approved mentor protege. Mentor put a lot of money into the protege to do the mentoring. Now the protege, what happened to be an S corp, and the mentor was an S corp. Well, an S corp cannot own another S corp. An S corp can only be owned by individuals, not other companies. So once again, be very careful. But same questions to ask prospective joint venture partners. And I think we might have a little time for questions, because I saw a bunch of them flying in.
Oh, there are a ton of questions. I mean, what a wealth of knowledge and information here.
Sorry about that.
No, please don't. This is fantastic. I'm going to ask some of the simpler questions that we'll get those out of the way, because multiple times Our listeners have asked a question: how many simultaneous JVs can a company form? Is there a limit?
Well, that's a great question. With the same joint, so if you want to form 100 different JVs with 100 different partners, there's no rule against it, right? I mean, I would never recommend 100 because it's hard to manage something like that. But if you might have a small business, 4 different joint ventures with 4 different small business joint ventures, because maybe you are a woman-owned business and you want to have a joint venture with a veteran-owned business, or you want to have a joint venture with an 8A business. That's perfectly fine. If it's the same business, meaning the same joint venture partner, then the 3 and 2 rule applies.
Got it. Okay. So hopefully that clarified a bunch of questions here. We're getting a lot of requests here for slides in the recording. As I mentioned when we started, AACC members will receive the slides immediately. The rest of us, we will post the recording and the slides for everyone, but our members get them first. But we will make it available to everyone. Okay, more questions, and we could probably do an entire session just on JVs alone or MPPs alone.
We should actually think about that. Just doing just a talk, just answering questions like a moderator session in the future.
Yeah, absolutely. We'll have that for our audience. But today's question, really, a couple other questions that I'd like, if you have a few minutes, is to. One of the questions says, is there a way that a mentor protege could use past performance acquired in the name of a JV? This is now mixing JV with mentor protege.
It depends on what the solicitation says. I mean, there was I was just reading, in the past month and a half, reading the STARS 3 solicitation and the questions and answers. And there's a lot of questions on past performance of partners, et cetera. You really have to look at the solicitation and ask the questions during the RFI project. There's no, it's really up to the contracting officer as it relates to past performance.
Okay. Few duplicated questions asking the same thing. There's a lot of confusion between unpopulated and populated JVs. Can you clarify that? Or do all JVs start out as unpopulated?
So think about it. This is where I really wish I was in front of the audience, because I love speaking in person. But think about this: your company is ABC, the other company is XYZ. You form a joint venture, and that could be JV. We'll just call it JV. Well, you keep your own employees. The other company keeps their own employees, but the JV hires its own employees. That's a populated joint venture. An unpopulated joint venture is the joint venture has no employees, but instead subcontracts to each of the joint venture partners. So you as a joint venture partner will get a subcontract from the joint venture, and the other joint venture partner will get a subcontract from the joint venture.
And how does the socioeconomic if it is an 8A, for example, how does that rule apply then if the JV itself does not hold any employees?
The JV can't, because the SBA's rule states that you could only have unpopulated joint ventures, especially when you have a separate legal entity. So you as the 8A have your own employees, and your joint venture partners has their own employees. And how you perform the work will be based upon what the work scope is. So for instance, and I'm just going to use the old rule because it's easier to understand. A lot of people still think in terms of the old rule. If, for instance, you have to perform the prime contractor would be the joint venture. If it's construction, general construction, the prime contractor would have to perform 15% of the work. However, the 8A, as the 8A partner to the joint venture, would only need to perform 40% of that 15% of the work. So the work percentages will be based upon the joint venture work percentages, and then you further look at work share after that. So you know, I don't know if I should probably share my screen again because I give you my my email address, because that would really help if you have these types.
Yes, please. There's a lot of requests for, I think your mailbox is going to be flooded at the end of this.
Uh-oh. Go ahead.
All right. And I think this particular question, I am interested in knowing myself, because Beyond Stars 3, for those of you on the line, that's going in next week. You'll be done with it. But CIOSP 4 is coming up. So this is very important question. Does the certification such as DCAA, accounting, CMMI, and all the industry certifications, do those get inherited by the JV through one of the members?
That's a great question. And once again, that's going to be up to the contracting officer. And there may be an RFI on it. This is when it comes to past performance or anything like that, it's up to the contracting officer. I've seen where contracting officers have put in solicitation that they're only going to allow past performance from the JV, which means that you would have had to perform with your JV partner on another project to get that past performance. I've seen, however, a lot of contract solicitations saying that we will allow the past performance of one of the JV partners. And that's why a lot of people want to do JVs. So, but it's up to the solicitation. You have to read it carefully.
So for those of you planning on bidding on CIOSP 4, start asking that question right now, because I know this is a burning question for all those points that you need to amass.
Exactly.
Michelle, I don't know how much more time you have, but
I have another 10, 15 minutes. So I would be happy to answer.
I'm going to take a few more questions. And I think when you started talking about JVs, the line started burning up. So in terms of the number of contracts that a JV can hold, and at what point can a JV no longer have contracts? Is there a limit?
No, I mean, the limit is the 3 and 2 rule. That is the limit. So the limit is you cannot be awarded more than 3 contracts over a 2-year period. And then you can joint venture with the same guy again, or the same company again. You just need to create a new joint venture.
Gotcha. Okay.
Now, if you create a joint venture and you just, and maybe you're doing it on a private level. Maybe you've got a joint venture and you are actually been in business together as joint venture partners for 10 years and doing commercial work. You could definitely lose your 8A status from that. You know, you've got to be very, very clear with the SBA what you can and cannot do for ongoing joint ventures, let's say outside of the SBA federal contracting program.
All right, I'm going to take one last question, and this is probably going to take a lot of time. That's why I'm using this as my last question. A lot of confusion over CTAs, GSA CTA versus just a CTA. Can you explain what the different types of CTAs are, and privity of contract? Can 2 companies be primes on the same contract when they are a CTA?
I believe so. And forgive me, I was working about it's got to be about 6 years ago. For some reason, everybody was doing the CTAs with the GSA. And so I have to be honest, I'm not as familiar with the rules anymore. They're just not at the top of my head right now. However, the GSA I found had a great website, and they actually had their own form of CTAs, right? They want you to use their form. It's called a contractor teaming arrangement. And that's, it's used when you each have schedules, FSS schedules. So you have Schedule 70 contracts, each of you, okay? And they have specific rules on teaming and how to do it. And I'm just sorry, I can't really get into it right now. If we end up doing another moderator session, then I will be up on it again. But most of my clients are not working with contractor teaming arrangements right now. That's CTA versus a teaming agreement. All of my clients are utilizing teaming agreements for prime subcontractor teams, whether it's for Army Corps of Engineers projects, VA projects, Department of State projects. But the CTA, contractor team arrangement, I think that it's called. It's specific to GSA schedules.
Yes, so GSA has their own definition of a CTA. And as you know, Michelle, I didn't mean to put you on the spot there, but I do want to, we get asked that question all the time. Why can't I form a CTA? CTA for anything outside of GSA, as far as we know, is nothing but prime sub or some version of teaming, but not the privity of contract as GSA would allow you. So ask a question before you assume that's what a CTA means,
Right.
anything other than GSA. There are over 40 questions that have come in, and the lines are still burning up. Everybody has Michelle's email address. You feel free to reach out to her. Feel free to reach out to me. Michelle, we would love to bring you back again for another session and hopefully actually do a seminar versus just a 1-hour webinar.
Yeah, I could do. I'd be happy to do a workshop. And then also, you and I could talk if you want to. I don't know if you could capture those questions, and maybe I could work through them, and we could do a little publication for everybody.
Yes, we have captured all the questions, so we will try. I will send those to Michelle, and we'll try to record those answers if we can and get them out. We truly want to answer everybody's questions, but there are some that are too specific to your situation that I cannot bring up here, and others that are great questions, but we'll probably spend another hour, 2 hours doing this. So I want to thank everybody for attending today. Again, please, if you have more questions, send an email to me, send an email to Michelle. We want to help you. We want to get these out, the information out there. Michelle, thank you so much for your time. Very grateful. And thank you all for attending today.
Thank you very much, everybody.
I would like to take this opportunity to thank all the contracting committee members for their dedication and support to make AACC Government Contracting webinar series possible.